I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video will discuss how Social Security benefits are taxed. Unlike most other forms of income, which are either always taxable or never taxable, Social Security benefits are sometimes taxable. While this makes it kind of tricky and annoying, it also means there may be some planning opportunities you can take advantage of to try to minimize how much of your Social Security is ultimately taxed. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Let's start with state income tax. As of the creation of this video in May 2020, only 12 states potentially tax Social Security benefits. 38 do not tax it at all. The 12 states are Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. Each state has slightly different methods for calculating how much of your Social Security, if any, is taxable. Most of those methods are based on your level of total income. So even if you live in one of these 12 states, it's possible you won't have to pay any state income tax on your Social Security. If you would like to know how each of the 12 states tax Social Security, take a look at their respective income tax return instructions for more information. Unfortunately, detailing all 12 sets of laws would be a bit too cumbersome to do in this video. And keep in mind, like all tax legislation, things are always subject to change. Especially now, with the economic impacts of the coronavirus pandemic, I have to believe state budgets are in real bad shape. So I wouldn't be surprised if more states began taxing Social Security at some point in the not too distant future. At the federal level, anywhere between 0 to 85% of your Social Security benefits are taxable. The percentage of your benefits that is included in your taxable income is based on how much total income you have. Specifically, it's based on a special measure of income called provisional or combined income. Your combined income is equal to 1/2 of your Social Security benefits, plus all your other gross income, plus your non-taxable interest income. I'd like to dig into each of these a little bit more. The half of your Social Security benefits is half of your gross benefits, not the net amount you receive after the deduction for Medicare premiums or any tax withholdings you may have taken out. You can find the gross amount of your benefits by looking at Box 5 of Form SSA 1099, which is the annual benefit statement you receive from the Social Security Administration each year at tax time. And the measure of gross income used is not exactly the same as what's used elsewhere on your tax return. There are some very minor changes. For example, in determining your combined income, you're not allowed to take the student loan interest or tuition and fees deductions that you're otherwise able to take for purposes of calculating your gross income. The other important thing to keep in mind with the combined income formula is that you have to add in any non-taxable interest income you have. Many people invest in securities like municipal bonds because the interest paid on them is not taxed at the federal level. But for purposes of determining how much of your Social Security is taxable, you do have to include that interest. You can see how much non-taxable interest you have by looking at Box 2A of your tax returns Form 1040 or 1040-SR if you're 65 or older. If you're really interested in knowing the exact formula for calculating your combined income, you can take a look at the top few rows of the Social Security Benefits Worksheet and the instructions to Form 1040 or 1040-SR. However, all tax return preparation software will automatically do the calculation for you. Once you know what your combined income is, you can then figure out how much of your Social Security is taxable. There are a few different tiers of taxation based on your tax return filing status and your amount of combined income. If your filing status is single, head of household, qualifying widow or widower, or married filing separately, none of your Social Security is taxable if your combined income is below $25,000. But note that if you are married filing separately, you must have lived apart from your spouse for the entire year. Otherwise, the amount of your benefits subject to taxation is automatically 85%. If your filing status is married filing jointly, none of your Social Security is taxable if your combined income is below $32,000. If you're single or the other filing statuses, up to 50% of your Social Security is taxable if your combined income is between $25,000 and $34,000. If you're married filing jointly, up to 50% of your benefits are taxable if your combined income is between $32,000 and $44,000. Finally, For single and the other filing statuses, up to 85% of your Social Security is taxable if your combined income is above $34,000. And if you're married filing jointly, up to 85% of your benefits are taxable if your combined income is above $44,000. You may have noticed I said up to 50% and 85% of your benefits are taxable. The formula to determine the actual percentage is a bit convoluted, as it actually does 3 separate calculations and then takes the smallest of the 3. With that said, walking through the intricacies of the formula would be a bit too unwieldy to do in a video. Thankfully though, this is also something that tax return software does for you. But if you really want to see the full details of the formula, you can step through all 18 rows of the Social Security Benefits Worksheet in the Form 1040 or 1040 SR instructions. It's a bit tedious to do all the steps, but if you can maintain concentration long enough to actually get through it, you'll be able to see the calculation come to life. So now that you know the amount of your Social Security benefits that is subject to taxation is dictated by your other income, what can you do to try to minimize the tax on your benefits? Well, first, be aware that non-taxable interest hurts you for purposes of Social Security taxation. Now, I wouldn't necessarily let the tail wag the dog and say to avoid all non-taxable interest, because the overall tax savings on the interest could more than offset the tax on Social Security you may have to pay. But nonetheless, be aware that non-taxable interest isn't as great as it sounds when you're a Social Security recipient. The other planning opportunity is to try to find ways to keep your gross income low to minimize your combined income. For example, the distributions from traditional IRAs are fully taxable and will count towards your combined income. On the other hand, distributions from Roth IRAs are not taxable and are not considered gross income. Therefore, they will not count toward your combined income. Taking meaningful advantage of Roth IRAs requires some longer-term planning ahead of time to try to get your money into Roths instead of traditional tax-deferred accounts like 401ks and IRAs. There are some other less conventional ways of generating retirement income without increasing your gross or combined income. As an example, if you have a cash value life insurance policy you really don't want or need to keep anymore, you could potentially take cash out of the policy and use that to meet some or all of your income needs. Or you could also possibly tap the equity in your home to generate income. Though keep in mind, that means you spend down the equity you have in your house, which should rarely be your first option for meeting your income needs. But it may be an option nonetheless. Before we wrap up, I just want to touch on federal tax withholdings from your Social Security payments. If you choose to have taxes withheld, download and fill out Form W4V. It's a fairly straightforward form, but you're limited in the amounts of taxes you can actually have withheld. Specifically, your only options are to withhold 7, 10, 12, or 22% of your payments. Once you're done filling out the form, either mail it or take it in person to your local Social Security office. Well, that's it for this video. I hope you enjoyed it. If you want to learn more about Social Security, you can check out my other related videos such as Introduction to Social Security. And keep in mind, all of what was discussed in this video is based on current legislation. Again, considering the economic impacts of the coronavirus pandemic and the fact that the Social Security system was already strained before the crisis, it's almost a foregone conclusion that some provisions of the Social Security system will be changed. Part of those changes may be how benefits are taxed. To learn more about this, you can check out my other video, Will Social Security Run Out of Money? And if you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.